I think we're going to get started. So, good afternoon, everyone, and welcome to today's webinar, where we're going to be diving into the current issues that are impacting the success of investment-backed startups. So, my name is Tom Glasson. I've spent over 20 years scaling B2B tech companies as a go-to-market leader. I also run the UK chapter of Pavilion, which I'm sure some of you know, maybe even be your members of as well. We're a community for the best go-to-market leaders in the world. We have 10,000 members globally, but my day job is the CEO of Scalewise, and we partner with ambitious seed to Series C tech companies, helping them to optimize their go-to-market strategy and ultimately secure the expertise needed to drive capital efficient growth. Now, I'm absolutely delighted to be joined today by two exceptional leaders who between them, I think, have a combined 50 years of experience in scaling early stage B2B tech companies. First, we have Munya Hoto. So in my view, probably one of the best demand gen marketers in Europe. And with multiple successful exits under his belt, Munya now leads our marketing practice and our diagnostic offering as the Chief Strategy Officer at Scalewise. And as someone who supports many of our clients with probably their meatiest go-to-market challenges, Munya's got a really good and broad view of the issues affecting growth at a company level. We're also joined by Sam Jacobs, who really needs no introduction. Sam's an industry titan, I think it's fair to say now, also a LinkedIn celebrity. But more importantly, Sam has over 2 decades of experience, successful go-to-market leader. He's now the CEO of Pavilion, and Sam brings some unique perspectives about the challenges that revenue leaders and founders are facing at an individual level as he supports and mentors many of them within Pavilion as well. So thank you both for joining us today, Munya and Sam. So we've only got 30 minutes, so we're gonna be diving in pretty quickly. We'll hopefully have a bit of time for questions at the end. Feel free to use the chat and the question box to add your questions in. If we don't get a chance to answer them today, we will follow up with you as well. But this webinar is actually the first in a 3-part series. So in today's session, we're going to be focusing on the current trends in graduation rates, the specific problems startups are encountering, and the hidden forces that are often holding them back from success. Then in part 2, in early December, we're going to be diving into the importance of effective issue diagnosis and how diagnosing underlying problems is actually the crucial first step to sustainable growth. And then finally, in part 3 in January, we're going to share some proven strategies for scaling and long-term sustainable growth. So rest assured, you will be invited to the other webinars. So the next one, as I say, will be early December, and you'll get an invite for that. But for now, let's dive into today's topic. And I thought I'd start with a bit of data. So it's clear we have a major issue within VC-backed startup and the ecosystem that we're in. Well, while we're hopeful, I think that upcoming interest rate cuts and perhaps even increased political stability following the US elections, maybe that may drive IPO markets and stimulate fundraising again. But I think we're still seeing the aftershocks of the end of the zero interest rate policy era, what's called ZIRP. And I think what's happened is this has exposed real cracks in the VC model and the companies they invest in. And one of the most alarming indicators of this is what you can see on the charts here, which is this steep decline in graduation rates between seed to Series A and from Series A to B. And the chart you can see on this slide have come from a report released last week by Silicon Valley Bank. This is based on US companies, but it shows a troubling decline of these graduation rates. As you can see on the left-hand chart, which is the C to Series A graduation, it's been really around 20%. And it's kind of consistently been at that level, i.e. 20% of seed companies graduate to Series A. Really since 2010, that's been the case. But for the 2022 cohort, only 8% have successfully graduated to Series A. We shouldn't read too much into the 23 cohort, probably not had enough time to mature, but indications are that it'll end up in a similar place to 22 at around 8%. And then on the right-hand side, you can see the decline is actually even more severe in Series A to B. So previously, these graduation rates hovered between 30 and 40%, but for 2022, it's now dropped to a shocking 10%. And although not on this slide, the declines from B to C are actually quite similar as well. So that's the US picture, which generally we see as being better than the UK. And it is a lot better. Unfortunately, the story is even worse in the UK. And this slide highlights just, I think, how dire the situation has become. So this was research conducted by Scalewise last month, and it shows the C to A graduation rate for that 2022 cohort has plummeted to just 4.5%, down from 12.5% in 2020. And that steep decline of the white line that you can see on the chart indicates that now over 95% of companies that raised a seed round in 22 have not been successful in raising a Series A. Now, I think it's probably natural to see some decline in these rates of graduation following ZERP and the kind of COVID-induced funding bubble, as companies, I suppose, struggle to live up to maybe the inflated valuations that they were given. The scale of this problem, though, I think points to deeper issues. And our strong belief at Scalewise is that many more startups could be successful if they know how to navigate the hidden market and operational forces that are working against them. So today, that's what we're going to be exploring. We're going to be exploring the hidden forces that are at play here. And we're going to discuss a little bit why some of the traditional approaches to scaling simply no longer work in their current market environment. So with that, we're going to dive into our first discussion topic. There's going to be no more slides from me, so I'm going to turn the slides off. And we're going to look at the operational forces that are currently at play in the market. And, I think we've talked a little bit about the market forces, the high interest rate environment, the fact that this is putting pressure on businesses. But I think there's also some forces here around budgets being tightened for buyers and the, I suppose, increased scrutiny on the buying process and the number of stakeholders that are now involved. We're certainly seeing things like win rates reducing. Pavilion's data with Ebster earlier this year showed that they're 18% down. Average sales cycles are lengthening up at 16%. And we have this explosion of tools, I think, all competing for smaller budgets, which is creating kind of further headwinds. But that's, I think, enough of the market forces. What I really want to dive into with Munya and Sam here is some of the operational forces at play. And I think maybe, Sam, starting with you here, I think maybe some of the challenges we see here is this kind of mismatch between VC's growth expectations and the reality of what's actually possible within a business in terms of creating that sustainable growth. And maybe you can give us your perspective on some of those forces and maybe how even LPs are applying pressure in that way as well.
Sure. Well, thanks for having me, Tom. Great to see you, and great to see you, Munya. Two people I've known for quite some time. Yeah, I don't think anything I'm going to say is particularly life-changing or revelatory, but nevertheless, it bears stating. So the first issue that we have is that a lot of VCs invested at valuations in 2020, 2021, and 2022 at the beginning of 2022 that were predicated on, ZERP, on a very low interest rate phenomenon, which inflated valuations and created a lot of tailwinds, both not just for valuations, but also for enterprise CIO budgets in terms of purchasing software. And so we have the reality that as interest rates rose and growth expectations contracted, you have a lot of people that invested at valuations that are now not perceived to be particularly attainable because multiples have come down so much. So you have this issue, which is that even though some of the companies have actually doubled, even tripled revenue from the time that they raised money, those multiples might have been 20, 30, 40 times ARR. And now multiples for software businesses, for typical SaaS software businesses that aren't, core AI essentially, are back to where they were, maybe a little bit lower than they were prior to, the heyday, which means 5, 6, 7 times ARR, as opposed to 10, 12, 15, 20, 30 times ARR. So the reason, and so what does that mean for graduation rates? Well, even if the company is a good company that may or may not be running out of money, you have a hidden force behind that. See, a lot of the times we talk about how it's, the venture capitalists or institutional investors more broadly are at fault. but we have to understand their incentives. So they are primarily compensated. Yes, the ultimate outcome that they're seeking is cash on invested capital, actual distributions on invested capital, meaning how much did they put in cash and how much did they get out in cash. But the venture investment life cycle is 7, 10, 15 years, particularly if companies are staying private for much, much longer. So what happens in the absence of that? Because really what happens when you become a venture capitalist is, the first motivation that you have is around generating returns. But quickly what you realize is that your primary motivation actually becomes asset accumulation, right? So in the world where your returns are pushed out over 10 years from the moment that you write the first check, what you quickly figure out, unlike, and there's exceptions to this, but what you quickly figure out is that what you really need to do is raising new funds all the time, because you get 2% management fee on top of those funds. So the way that you do that is you present your fund performance back to your investor base, who are your limited partners, which we call LPs. And when you do that, you are presenting the most recent valuation for whatever checks you wrote into those companies. Now, if there was a more recent markup or markdown, right? If you had to price the company in between when you wrote the check, and you had to price it in this environment, then you had to write down the value of that investment, sometimes very significantly. And I talked literally yesterday, so this is fresh from the real world. I talked to a venture capitalist investor who was discussing an M&A opportunity where they were trying to sell a business, and they had written such a large check into that business that if they had to mark the asset to its true value, which effectively was zero, they would have blown up their entire second fund. Their entire second fund would be underwater, and they would not be able to go back to their LP base and raise their fifth fund or whatever fund that is that they're raising now. And I've heard about that from all over the ecosystem, where it's actually better to let the company get nearer to death sometimes than take the pain of having to mark the security, in this case the company, back to the market. So one of the reasons that you're going to see difficult graduation rates is because people are holding out as long as they possibly can to not have to mark the companies to their true market price, which is what would happen if they had to raise a down round, for example, and reprice all the securities. Now, that's not true of everybody, but that's certainly one of the forces at play. And that's why it's really, we have to understand, Charlie Munger talks about incentives, or I guess used to talk about incentives, but the point is, we have to understand the incentives of all of the players in the ecosystem. And one of the primary incentives is really around the investors and who they answer to. And they are in the business of raising more funds, and they are going to have a lot of difficulty raising more funds if they say, listen, we're a new venture capital firm, our second fund, not only did it not return the fund, it returned 50 cents on every dollar, and you would have made 5 times more money just putting it in the S&P. That's a bad pitch for VCs, and that's one of the things that is compressing the graduation rates.
Yeah, it's a really good point, Sam. And I think what you're talking to here, alongside the issue in terms of incentive alignment, is actually, what do these investors really, really want? And can they really drive the right, I suppose, actions and behaviors and outcomes within the businesses that they're supporting? And I think part of the challenge that we see as well is, in the UK in particular, only 8% of VCs have actually got hands-on operational experience. A lot of them have come from corporate finance or banking. They're very good at the numbers, as you say, and thinking about the fund economics and where to invest. But when it comes to actually providing actionable advice and hands-on real lived experience, I think often in the boardroom, some of that advice isn't always the best. And I think it can lead to decisions that waste capital and sometimes even can be decretive in terms of the valuation of that company. And when you maybe one of those issues, and I've seen this quite recently, is where that tightening of ICP, which is so important, as a startup and even as a scale up, sometimes it's not really happening. And sometimes it's been driven by, the forces at play from VCs that want you to have this big market to go after, that want you to be able to paint this picture with this huge TAM and the valuation. But actually, when it comes to executing, you need to be hyper-focused and uncomfortably narrow. Maybe you can talk about some of the things you're seeing around ICP in the companies you're supporting.
Yeah, Tom, thanks for having me on, and hi, Sam. Good to see you again. You're absolutely right, Tom. Just double-clicking on what Sam said about the environment in which some of this capital was raised. everybody has a formula or a playbook of how to, build a valuation hypothesis around a company. What I started to observe and what I see in the companies that I work with is that we started to break our own rules when it came to figuring out how much this company is worth in potential. So what you often found was in the pitch decks that these companies are producing as they go out to go and raise capital, they might have revenue concentration in a particular sector, for example, banking, where they have 3 customers, but 3 customers make up 82% of the ARR. And then the rest of the long tail is where they have the majority of traction from a product market fit perspective, but actually they don't have the revenue that's supporting that. So what you end up having is VCs that are loving the fact that we've got 3 huge logos in banking, but the fundamentals of the business and the product that's been engineered actually doesn't support those customers well at all. It just supports a high valuation when you go and raise money. And so the competition for customers like that and investable assets like that led to this scenario where people could go and raise loads of money based on winning a few logos with very high revenue concentration, and then churning those customers through the difficulties that we went through, and then realizing that actually we don't have a really big business or even one that can support enterprise customers. We've got a SMB mid-market targeted organization or software company, and actually we didn't need as much money as we took, and we're not nearly worth as much as we could, as much as we promised we were at that time. So when I go into organizations and I do the ideal customer profiling work, it's not just about, what is the historical revenue attainment by industry or logosphere. It's actually about, in recent times, where are we able to prove that we have product market fit, and where are we having customers that are can be attained at a good price and actually stay for a very, very long time and convert at a high rate. And that was abandoned when there was free cash floating around and everybody went after assets that had few logos with high revenue concentration. And as a result, the principles around ideal customer profiling went out the window, and you're left in this situation where those companies no longer have those customers. They don't have the revenues to support the money that they raised, and now they're stuck with a business that they don't like, that investors don't like, and that the LPs are asking questions about. So there was a whole bunch of bad practice that emanated from trying to raise and spend as much cash as possible when there was a zero interest rate environment.
It sounds like what you're saying is the kind of zero interest rate era kind of papered over a lot of the cracks and allowed people to kind of spend their way out of some of the issues and maybe lost sight of the kind of core fundamentals of running a proper business, of which, capital efficient growth is certainly one of them. Maybe Sam, you can give us a sense as to how you think about as a founder now prioritizing kind of instinct over data or vice versa, because I think what Munya and I certainly see a lot is that these founder-led businesses, where a lot of the kind of early stages of growth have been over instinct and the founder's ability to kind of make the right calls at the right time. But actually, I think part of the challenge now in this kind of tighter capital constrained environment is data is becoming a lot more important for VCs when they're investing. And how do you think about this shift from instinct to data-driven approaches? And in particular, at what point should companies be thinking about how to be more data-driven in their approach to scaling?
Well, that's a great question. I think data, and this is certainly a challenge and a mistake I feel I've made in the course of my growth as a CEO, which is that in the seed stage, in the very early stage, a lot of product market fit is driven by intuition, largely because you don't have enough data to build any kind of algorithmic correlations around. And then as you get bigger, you begin to rely perhaps over, you continue to rely too much on intuition and not enough on data. I would say probably 5, 6, 7 million in revenue, maybe a little bit earlier, is where you really have to slow down to speed up. And I think there's, benchmarks. The thing on my mind is that benchmarks can be really, really problematic if you don't have a core understanding of where the benchmark comes from, right? And my point is, if all you ever do to figure out what you should do is ask everybody else what they're currently doing today, and you don't have a first principles understanding of how business works or how value is generated, then if everybody's paying SDRs $90,000 or 75,000 pounds a year, you'll do that too. And if everybody hires a PR firm and is paying them 10,000 pounds a month because that's how you think you generate demand, and you never talk to Munya, then you'll do that too. And so benchmarking itself in the context of not understanding true business fundamentals is part of what happens and part of what pushes people and kind of puts them on tilt a little bit. And to the point, that's where, you say, well, I've asked all my friends, they're all doing this. This is what valuations are. And you're not looking at the core fundamentals. And that's where you make these intuitive decisions. And again, a lot of it is based on this fear and greed counterbalance where you're watching competitors sometimes and you feel like, and by the way, this happened to Pavilion. So Pavilion's in like this specific, we are a community, but we're also a business, and we have, competitors or other people in our ecosystem. And we were in this period where for 2021, 2022, I was comparing myself to a bunch of other very well-known, community organizations, for-profit communities, for-profit learning companies, where I felt like I was doing something really, really wrong. They were growing much more quickly. They even had a little bit more higher cash flow margins. They were raising money at higher valuations. And it just takes a tremendous, now this wasn't this wasn't really just because of my discipline. This was partially because of my sort of suite of choices. But for whatever reason, we didn't go all head over heels in terms of burning capital and spending all the money that we had on the balance sheet. And now we fast forward to today, and many of those companies that we were hearing about are in very dire straits, or have gone out of business, or are so far below their valuations that actually Pavilion all of a sudden looks like the blue chip, investment opportunity across that portfolio of community companies. And that wouldn't have been the case a couple of years ago. And again, that's related to benchmarking and judging your decisions, not even just intuition, but saying they're going big, I have to go big. If I don't go big when they go big, then I'm going to left with 10% market share in a winner take all market. And that kind of thinking, it's just all market dependent. And so, what I've learned and what we've learned is I'm willing to trade some amount of growth for additional deliberation around data, exactly to your point, Tom. And I'm willing to take 6 months, 12 months, sometimes 18, 24 months. I'm willing to forego the triple, twice, double, 3 times. I'm willing to forego some of the benchmark growth multiples in order to try and build something that's truly delivering value to our customers over a long period of time. But that doesn't make it easy. And the particular thing is, I'll tell you right now, it's particularly hard because right now, we had this terrible year in 2023, and then there's a lot of companies. And if you looked at the Pavilion Pulse report that just came out, there's a lot of companies that finally had a pretty good year. They had a decent year in 2024. And so now the instinct is, and it's even my instinct, which I have to temper, which is, all right, fine. I've taken my medicine. 2024 was okay. 2025, year of growth. And you have to really temper a little bit of that enthusiasm and say, yeah, we had a good year in 2024. Let's have a good year in 2025. And if I have to push out hyper growth till 2026, 2027, I'm willing to do that because I don't want to get caught up in the same merry-go-round. The biggest sin that we could all suffer from is getting caught back up into this hype cycle, maybe because of AI or some other reasons. And again, contorting the capital allocation part of your business, which just means spending too much money and giving your company back to investors. The beautiful thing about being profitable is that it's your customers that control your destiny, not your investors. But when you're burning a lot of money every month, ultimately what you're saying is that the capital markets get to decide whether or not I continue to be a company.
Really good point, Sam. And you touched on their capital allocation. And of course, that is so critical for any early stage company. You've often got 18 to 24 months runway where you've got to go out and raise again. And how you spend every pound or dollar is absolutely key. And I think some of the issues that we see, again, operational forces at play, as it were, are capital misallocation, consistently spending money on the wrong things. Manu, I know you've had some very recent examples of this that perhaps you can share for the audience here.
Yeah, Tom, I couldn't agree more with kind of the points that are being made here about the pressure to spend that cash as well. So many people on this call would have felt the high of going out and actually raising a round of venture capital, and the feeling of having that war chest at your disposal. The challenge with that is that because the relationship is at a high both for the VC and for the company that's just raised, that there is a lot of faith in what that money can achieve and how quickly it can turn around that investment into actual ARR or even profit. What we start to see when you have that kind of hyper positive attitude floating around between the investors and the executive team is that we go and buy a whole bunch of stuff that we genuinely don't need, but because of hearsay and what's floating around in the founders WhatsApp group or what the VC heard from another portfolio company, what you end up having is an overinvestment in tools and technology that has nothing to do with your go-to-market motion. Even at times, I see the insides of companies that have tools that they never even opened the box on, but these were kind of standard, kind of protocol, having raised your war chest that everybody buys, the latest attribution tool and also the latest data enrichment tool, and they upgrade their CRM to whatever the latest one is that's on the marketplace. place. And that's because that's what fast-growing companies that are going to triple, 3 times, and double are supposed to do. And because of the dynamic of that emotional hubris that appears when you've got loads of cash floating around, is that you actually allow that to persist for maybe 6, 9, 12 months before you realize we've just lost about a year of execution, maybe 10 heads that we could have hired to be really, really effective. And now we've got less cash and less time, and we're struggling to justify or even understand what actually went wrong. So, part of my counsel would just be simply to reduce the volume and tone down the what is everybody else doing from an investment and buying toys perspective, because then you just become a baby Huey. You grow bigger, but you don't grow up, and you can't scale your business in a good way.
And Sam, what areas do you see capital being wrongly allocated, in these early stages of growth? Where do you see it most commonly being wasted?
Well, 2 places. The first is just too many people. And I think that figuring out the hardest thing as a founder or CEO, and there was a woman, Britta, I think, asked a question in the Q&A about, seed stage companies. I think the hardest thing to figure out is what is your true capacity? Like, what is everybody's capacity in the organization? And so you sometimes, particularly if you are trying to build a leadership team of people that want direct reports, everybody wants direct reports because they want to say they have a team of X size. And so you keep giving budget to people that haven't demonstrated an ability to hire efficiently, which just means trying to do as much as possible with a smaller number of people. And I think the hiring profile really needs to evolve in this environment. And one of the places I would encourage people to focus is around every person in the organization probably should have some level of technical capability. And I don't mean that they all have to write code, but everybody needs to be tinkering with OpenAI or with AI in some kind of form and understand how to build like a GPT. Everybody should be testing how to use clay.com or copy.ai or some of these tools. Like you can't have anybody that really has no ability to do anything themselves, but can only delegate and build presentations. So that's one thing I would say. And then specifically around demand generation, I find that people are spraying and praying again, too much. And we were talking about it on LinkedIn yesterday, people that, have low conversion rates and low win rates already. And then what they do is they buy some, email cannon and they start sending 10 times the volume to make up for the fact that they have like a 10% or 8% win rate. And instead of fixing the core issue first. So it's really like trying to grow too quickly before you have demonstrated clear product market fit and ICP, product fit, which is what Munya was saying.
Yeah, and I would just add to that, Sam, it's such a good point. And the common issue that I see or force that I see at play is when you've got a non-commercial founder that wants to kind of delegate or outsource the sales problem too quickly. And they end up hiring a sales leader way before they should be hiring them. When really, getting to product market fit and those early stages of kind of internalizing those learnings from the market and the product feedback, that really needs to come from the founder. And a lot of work that we do at ScaleWise is picking up the pieces actually after that initial sales hire gets fired 6 months after being hired. But that's a massive knock-on effect for that company. When we think about the time horizons that they're working to, the runway that they've got, wasting the time hiring them, onboarding them, perhaps even that sales leader's hired people as well underneath them, and then they're all getting fired, and before you know it, you've lost 12 months of half of your runway. So it's a big issue, and I think non-commercial founders shouldn't do it alone. Get help, get support, and ScaleWise is here to help coach and support non-commercial founders, or maybe even look at a fractional leader as an option to support maybe coaching or onboarding those first few reps that you hire. But please do, whatever you do, don't go and hire an expensive sales leader when you're in those early stages of growth, because it can be really, really detrimental to your business. So I'm conscious of time. It feels like we could talk about this for hours, but I know we've only got 30 minutes. Maybe just to, I suppose, wrap up quickly, Munya, on what are the kind of traditional approaches to scaling that maybe once worked in a ZERP era that now you just got to say no to? And we'll just kind of wrap up with that as a final statement.
Yeah, Tom, I think Sam touched on it just now to say you go and you just target volume when it goes to hiring instead of actually building a motion that you can scale effectively. This is, to me, fundamental. Most of the people that raise money are under a target to go and build a size of team rather than a pace of demand generation. And so they don't have the fundamentals in place, and you just fill the building with people that can't execute. I would say building silos too early. Again, this is driven by the fact that you go and hire a sales team and a marketing team and a customer success team, when you're just at, maybe just post 1 million in ARR, whereas you should be building a consolidated, integrated demand gen organization that works together to drive the business forward in a good way. If I had to pick two things that I would break apart and not advise freshly minted companies to do, is to overhire without really building that demand gen platform, but also verticalizing and creating silos in your organization way too quickly.
And I know I said it was my final question, but actually I'm going to have to direct this one at you, Sam, because it relates to the order of operations, because this is the other, I suppose, traditional approach of just like, let's just load up sales headcount. Let's have a top-down driven headcount revenue model without really thinking about, I know what you call the order of operations. Do you want to just quickly explain what that means?
Sure. And when I say this, I don't mean individual people, but basically, I mean centers of excellence, which is, sort of what Munya was referring to. So the first thing, this is my opinion, right? And people can say, well, look at Microsoft Teams versus Slack. Well, sure. If you're comparing yourself to Microsoft, then this isn't going to be as true. But first thing I think you need is a great product. Then I think you need marketing. And then I think you need sales as centers of excellence. And what I mean by that is a great product is the thing that generates enthusiasm from your customer base. Marketing is the thing that harnesses that enthusiasm and broadcasts it to the right people at the right time and delivers them a message that is compelling based on their problem. And from there, you turn that interest that you've generated from marketing or marketing activities, even if it's SDRs. The point is giving the message out to the universe so that it can find the right people. And then once they're interested, you turn that interest into revenue. And that's what sales does. But I think people tend to make a mistake of hiring sales way too early. And I don't mean a salesperson. I mean the department of sales with a sales manager and account executives. And they're talking about pipeline and forecasting before they've demonstrated that they can feed those salespeople with the right opportunities. The last thing I will say before we go, I know we're over, is and I've got a post coming out about this on LinkedIn. Click the little bell on my profile if you'd like to hear more. Is be wary. What happens in those situations when you try to grow too fast too early is you get into a churn spiral. The churn spiral is you have bad ICP customers that are churning at a high rate, but you're trying to demonstrate ARR growth, and so you find yourself dependent on the new business acquisition machine that you've built, even though the new business machine that you've built is bringing in high churn customers. And there's no way out of it unless you slow down the new business logo, the new business acquisition machine, and you let the bad churn customers churn out the backside. And what will happen in that case is you will actually show contraction, not growth. And you feel like you can't show contraction because you need to show that you're growing in order to raise the next round. Or maybe you can't show contraction because you're trying to run your business for profitability, and that would make your business unprofitable. And so it really is incumbent upon people to try and find good fit, long-term ICP customers as quickly as they can, because otherwise you get stuck in a spiral that you can't get out of.
We're going to end on that note. I've got a lot of takeaways from this, but my biggest one is we need more time. I think we could have dived into a lot of these topics in a lot more detail. Thank you, all of you on the chat that have agreed with comments that Munya and Sam have made, that have maybe asked a couple of questions. We'll definitely come back to those. I'm conscious of your time. We've gone 4 minutes over. Please do look out for invites. As I said, we've got the next webinar in the series coming up at the beginning of December, where we're going to really be talking about effective diagnosis of issues and how that can really help you chart that course to success as an early stage startup. Thanks for the great feedback on the chat as well. We'll let you get on with your day. We'll see you again in a few weeks' time. Thanks again, Munya and Sam. Amazing.
Thanks, everybody. Thanks for joining us.
Thanks.